Hey guys, how's it going? Steve here. In this video, we are going to rock variance analysis. I'll take you through part A of question Carad from the specimen exam, heavy variance analysis workout. If you like this video, check the description below. I've got courses, more ways to help you get a pass on ACCA PM. Without further ado, let's get started. I'm in the performance management specimen exam. In the real exam situation, I'm going to start in section A. I'm going to get warmed up there. I'm going to have a taste of all areas of the syllabus. When I've completed section A, I come over here to section C. I've got the first question open, question Carad. I check out the requirements and I see a variance analysis workout, heavy variance analysis calculations. Now, this is going to be a tricky part of the exam. I would probably move on to easier things. For example, the next part is a discussion part for 9 marks. I would do the discussion part first. Hopefully I'm getting 7 out of those 9 marks. Then I would only need 4 marks to get into the passing threshold to get an 11. 3 marks just to get a borderline 10. So guys, if you get something tricky like this in your PM exam, don't let it throw you off. Just come back and do it later. You can find easier things to do. That being said, let's rock this requirement. I see the verb is calculate. So putting discussion points here would not help you with any marks, so I'm going to avoid doing that. They've given us a spreadsheet. I love the spreadsheet. That's going to save us a lot of time. And we have a pretty big scenario here to read. Lots of numbers jumping out at me. Look at this big paragraph. Wow. You know, it's going to take me a long time to read all of this. So rather than reading this long story first, burning time and not earning any marks, I'm going to begin by setting up templates. So I'm now going to check out what variances we need to calculate. Well, we've got to do the sales price and the sales volume variances. That is 100% assumed knowledge from the MA exam. Then we've got to move on to the material price planning and price operational variances. That's new stuff from the performance management exam. And then we've got labor rate and labor efficiency. First thing that comes to mind here, guys, look at the marks. 9 marks of assumed knowledge, 2 marks of new stuff. This underscores the importance of revising the direct materials, the direct labor, and the sales variances, because those are assumed knowledge in PM. And as you see here, you could be asked to calculate those on their own. Let's get rocking. So we've got to do sales price variance and sales volume variance. I will use part of the spreadsheet here as scratch paper to organize my thoughts. There's no reason I can't do that. I can delete it when I'm done. So we know that we have a sales variance, and there are 2 reasons why budgeted sales can be different from actual sales. First thing is about the number of units being sold. Second thing is about the price being different, the actual price different from the standard or budgeted price. The variance that talks about units is the volume variance. And the variance that talks about the price is the sales price variance. What is the impact on profit of selling a different number of units? Well, the sales volume variance answers that question. And then what's the impact on profit of selling our units at a different price from our standard price? Well, the sales price variance answers that question to help us control performance. Now that I've recapped those ideas in my mind, I can delete this, don't need that anymore. I can now set up my templates, and I recall that I need the budgeted contribution, and I need to compare that to the flexed contribution. The difference between those figures is the sales volume variance. And then below that, we need to get the flexed sales, and we can compare that to the actual sales, and that gives me the sales price variance. So I'm setting up my template before I do anything. Now that we've got our templates deployed, we can start reading the story, plugging in the numbers, doing the math. Now, you might be wondering, why are we working with contribution if the name of the variance is sales? Shouldn't we be working with sales? Well, we're looking here at the impact of selling a different number of units. Now, two things happen if we sell a different number of units. The sales will change, but our variable costs will also change. So if we sell fewer units, we'll have lower sales, but we'll also have lower variable costs. So the net effect of selling a different number of units is a change in contribution. That is why we're using contribution here. Let's read the story. Let's see what we've got. Well, it's a big story. And we learn about the Carad electronics company, and they sell two products: plasma TVs and LCD TVs. And we have some actuals for the month. We've got the total units produced and sold. No change in inventory, which is nice. And everything we need for this part of the question is here in note 1. Now guys, in the real exam, I'd probably do all of these templates first, just to get really organized before I started reading. But for the sake of this video, let's do it part by part. Okay? So I learned that we have two products, so let's make a line for each product. We've got the plasma TVs. We've got the LCDs. And then we need a total. So budgeted contribution, we need to get the budgeted units. And we can learn that right here, right? 1180. Consisting of an equal mix of plasma and LCD. So all we got to do is 1180 multiplied by 0.5. That will give me the budgeted units for each item. Now we got to find the standard or budgeted contribution, and we have it right here, 190, 180. Team, again, for this demo, I'm going to leave these numbers without the equal sign so you can see what we're doing here. And I put it in the wrong place, as you saw. Now it's fixed. Okay. Now the flexed contribution, we've got to get the actual units multiplied by the standard contribution per unit. So look at that. I'm just going to change out this part. If you remember a flexed budget, that tells us how much contribution we should earn based on our actual units produced and sold. So guys, do we have any actual units in here? We do. We've got 750 and 650. So I'm going to plug those in. Now I'm all set up. Only thing left to do is put an equal sign in front of each. Now, of course, in the real exam, I would have been doing the equations one by one. I wouldn't have waited till the end there. That was just for our demo purposes. Guys, numbers are big. I'm going to now apply a tactical format so things are easier to read for me and the marker. And I can now get some totals here with the handy dandy sum function. Okay, now the difference between those two figures is the sales volume variance, 41,200. Now, the number is bigger here, and we're talking about contribution, not a cost. So that would be a favorable variance. You could just put F or FAV, and the markers will give you the same number of marks. Now, I'm going to get that out of the way. I'm going to get the next part out of the way for a moment. And we could make things look a little prettier with a little more tactical formatting. I wouldn't get any credit for that. As long as the markers understand your work, you'll get the credit. But let's get in the habit of making nice, professional, easy-to-read spreadsheets, because in your strategic professional exams, you will get professional skills marks for your spreadsheets, potentially. So get in the habit now of making easy-to-read, nice-looking spreadsheets. So we've calculated our favorable sales volume variance. That tells us that profit will be higher from selling a greater number of units. Now let's move on to the sales price variance. And I'm going to just reorganize things a bit. I'm going to use these same row labels. And now we want to know the actual units multiplied by the standard selling price. So I'm going to just copy those there, and watch this. I'll just take away the equal sign here now, just to make it easier for our demo. At this point, I want to replace that standard contribution with the standard selling price. And I can find that right here. 350 and 300. Okay. And so the flexed sales, that answers the question, how much revenue should we earn when we sell this number of units? Now, I can copy that right over here, and I can change out those standard prices with the actual prices. And what are the actual prices? We've got 330 and 290. And all we have to do is plug some equal signs in front of those equations, and we will then get results. And if I had been smart, I could have even copied that formula down, and because it's relative cell addresses, it would have worked perfectly. So I'm going to I'll rebuild it, not a problem. Move this down over to here. The difference equals this one minus this one. And look at this. The number is negative, so that will be adverse. And let's center all of that up. I think I forgot to grab one. I forgot to grab 1 or 2 rows there. Guys, there we have it. This is part 1. Let's label that for the marker. So there we have the sales volume variance and the sales price variance. Now let's move on to part 2, the material price planning variance and the material price operational variance. Boy, it's only for 2 marks. I'd be tempted to go do other things. This is a lot of work for 2 marks. But we're here together. Let's do it. Now, tactical decision, rather than going down, I'm going to go across because I've already resized these columns and I want fresh columns. So for this exercise, I will go across. And again, I will get organized with a template before I get started doing any math. Now, for the cost variances, for the direct materials and the direct labor, I'm going to use my alphabetical system. And it works like this, if you haven't encountered it in my other videos before. For direct materials, it's going to be the actual quantity of material used times the actual price that we paid. Right? The actual spend on materials. I'm going to go over 2. Then we're going to do actual quantity multiplied by the standard price. How much should we pay? How much did we pay? Should, did. Look at that. Only one variable is changing, and that's the price. So now I'm going to go over here. I'm going to change one more variable. Standard quantity, standard price. I find this a much easier way to do the variances. I just learned them alphabetical like this rather than memorizing all of these stand-alone equations. So now that I remember that, AA, AS, SS, I remember, oh look, it's the price that changes between these two, so the difference will be the price variance, and then the other one will be the usage variance. And that makes sense because it's the quantity that changes here. Right? But we're only after the price variance planning and operational variances, so this is just to help me get set up. So at this point, I don't need this anymore. And I'm going to move this over 2 more spots. The price variance will still be the difference between those 2 figures, okay? But to break it into an operational and a planning component, I need one more figure in there. And again, it's alphabetical order. So I'm going to remember operational variances here because O comes before P, planning. And now, all we've got to do in the middle, we're talking about a price variance. So I'm just going to copy this one over here, and I'm going to change it to the revised standard price, okay? I need a bit more room to do the math, so I'm going to Control X, Control V for paste. Now, let's dig around in the next note and find the actual quantity of direct materials. And we learn that there's a price variance of 28,000 adverse. So when we're all done, those two variances should actually net to negative 28,000. Hopefully they do. And what do they tell us? Each unit of television, it doesn't matter if it's a plasma or an LCD, it takes 1 unit of X. So that's maybe a simplifying assumption that both TVs are assembled with the exact quantity of component X. Doesn't matter. So it is 1 unit. So we sold a total of 1,400 units. So the total quantity, the actual quantity, will be equal to 1400 times 1, right? Or 1,400 actual quantity, actual quantity, actual quantity, right? So that AQ variable is not going to change. Do we have an actual price? Actually paid $80. So now I just have to multiply this by 80. And they tell us the standard cost is 60 per unit. And it takes 1, right? So that's going to be actual quantity standard price times 60. Now we've got to dig around in the story. We've got to find a revised standard price. And look at this. Due to a shortage of components in the marketplace, the market price went up to $85, right? So the planners were inaccurate. They did not foresee the shortage. So the revised standard price is $85. Now we've got the numbers in place. Let's add the equal signs like we did before. Get the results. And look at that. So at this point, I'm going to compare each of those figures. Okay, and now I'm going to move from the right to the left because we're moving from the flexed. This is actually the flexed, you guys. We're moving from the flexed to the actual. So that little arrow will just remind us we're going from the left, from the right to the left, excuse me. And I'll just do this, equals this one minus this one. And for the materials that we used, the budgeted price was 84. The revised budget was, the standard price was 60. Revised 85, right? So the planners were off. That's an adverse variance because that cost is higher. Let's label that adverse. And that negative tells us that it's adverse. And now we should have paid 85 per unit. considering the revised, but we actually paid 80. So our purchasing manager did a great job negotiating with the supplier, or potentially chose a different supplier. We're not exactly sure what happened, but we just know we saved $5 per unit. So the total impact there would be equal to the 119 minus the 112. That number is favorable because it is positive. It's a lower number. It's a cost, so it's favorable. Might as well just write it out this time. Why not? Okay. And give me a drum roll, people. Give me a drum roll at home. Let's add those two together. Hopefully we get that 28,000. Adverse, we do. Right on. I'm confident we've got the right numbers here. Let's grab all of this and give it that nice tactical format so it just looks really pretty for the marking team. There we go. Part 2 completed. Guys, if you want more information on this system, check my link in the description of this video. I've got other videos. I've got a course that you can sign up for, and I'll show you everything you need to know about variance analysis for the ACCA PM exam. Link is right below. Moving on now to part 3, the labor rate variance and the labor efficiency variance. I found this to be the most challenging part of this question. If you felt the same, if you got halfway through it and then decided to move on to easier things in the exam, I would respect that decision. But we're here. Let's take it together. Let's dive in. Let's label our work. And the direct labor variances work just like the direct materials. We're just going to swap out the quantity for hours and the price for the rate, right? But it's still the amount and the cost. So look at this. Actual hours, actual rate, actual hours, standard rate, standard hours, standard rate. What changes between these two? The rate, so I know that this side is the rate variance. This side would then be the efficiency variance. Efficiency variance tells us, did the workforce go faster or slower? Did they make more or fewer units per hour? Rate variance tells us about how much we paid. For the hours that they gave us, did we pay more or less than the standard or budgeted rate? Okay. So now if I try something here, I could get some partial marks potentially. So you don't need perfection in section C to get a comfortable pass. Now let us read. And boy, this is the biggest paragraph again. Difficult. In the time that it takes to read this and do this part, we could have written up most of that essay probably in the next part. Anyway, I digress. Let's do it. So a plasma takes 2 standard hours, right? Standard is budgeted. LCD should take 1.5 hours per unit. The standard cost for labor is $14, and this also reflects the actual cost per labor hour for the company's permanent staff. Complicated stuff. So the permanent workforce, they got paid their $14 per hour, no variation. However, because of the increase in sales and production volumes, the company had to use temporary labor at a higher cost. So there, the actual rate for some of the units is going to be higher than that 14. Now, the permanent workers can do 2,200 hours per month. We see that here. Assuming full efficiency, there's no mention that they're not at full efficiency to this point. And we learn that the workforce, they mean the permanent workforce there, were wholly efficient, taking 2 hours per unit for a plasma, 1.5 for an LCD. The total labor variance, therefore, relates only to the temporary workers who took twice as long as the permanent workers. So guys, here's what makes this tricky. We need to do a side working here. And I'll do it below. So guys, we got to get the standard. I'm changing my mind. I think I'll do it to the side. Standard hours for actual production. And we've got 2 units or 2 products. We've got the plasma, we've got the LCD, and then we add those up and we can get a total. And we made 750 plasmas, 650 LCDs. A plasma should take 2. An LCD should take how much? 1.5, right? Okay, let's put some equal signs in front of those. Let's add those up with the handy dandy sum function. That is how long it should take us to make those TVs. But we have a problem. Houston, we have a problem. We only have 2,200 permanent worker hours. So now we can do this. Perm worker total hours. The permanent workers give us 2,200. So now the difference between the 2,475 and the 2,200, that would be the part-time workers that we need to hire, the hours of part-time worker. So the temp worker hours needed, and that will be the difference equals this one minus this one. Okay, so 275. And they told us in the story these variances only relate to the temporary workforce. So let me just park this one column further to the left, to the right. So we have a spacer just so it looks nice for our presentation. Right, so we're back here in our template, and we know the standard hours, 275, okay? And what did they tell us here? The temporary workers took twice as long as the permanent workers to do their work, right? So they should take 275. They actually took double, 550. So I'll skip the formula there. I'll just use mental math, and I'll put a 550 there. If you want to do it in the formula with the times 2, go right ahead. Okay, now the standard rate that we pay is 14. Okay, If we didn't need the temporary workers, we'd be paying $14 per hour. Standard rate goes there again. Actual rate, we actually paid 18 because these are the temp workers. So guys, those are the figures that we need. Now I plug an equal sign in front of each to get the result of the formula. And I'm going to go from the right to the left. And all I'm going to do is subtract one from the other. The number is higher, therefore it's adverse, it's an overspend. We should use 3,850 worth of labor. We did use 7,700 worth of labor. So less efficient, they took longer. The cost consequence of that, adverse 3,850. And watch this, I can just copy that formula because it's a relative cell address. And we have an adverse 2,200, right? We paid more than expected. And if we did that correctly, that one plus that one should be equal to this number here, 6,050 adverse, and it is. Isn't that awesome? So again, I'm confident my numbers are correct. Let's clean things up a little bit. We can apply that same format. We can center it just to make it look exquisite there. And now look at that. Wonderful. Guys, that was a tricky part of the question, but we've now completed part A. We got the sales variances here. Part 1. We've got that price, operational, and planning variance breakdown over here. And then we just did the labor rate and labor efficiency variances. Guys, workout of epic proportions. Team, I hope you found that. Ladies and gents, I hope you found this video useful. If you would like to check out my solution to part B of the question, you can check out my other videos. Check the link below. Ladies and gentlemen, good luck on your upcoming ACCA Performance Management exam.